for the following session, where Dr. Gunther KRAUT from Munich Re will talk to us about challenges, products, and market development of epidemic risk insurance. Gunther is an experienced reinsurance professional with a detailed knowledge of both life and non-life insurance products. He is also a renowned industry expert and speaker who has given many interviews on epidemic risk. Gunther has been with Munich Re for 13 years, structuring Munich Re's first pandemic risk retrocession program in 2013. Subsequently, he initiated and co-led the Epidemic Risk Business Innovation Project, which was then transformed into a business unit with both pricing and underwriting responsibility and with a global mandate. Gunther holds a diploma degree in financial mathematics from the Technical University of Munich, as well as a business degree from LMU Munich. Subsequently, he obtained a PhD in risk and insurance with a research focus on extreme mortality risk, such as pandemics. Without further ado, Gunther, the floor is yours.
Thank you very much, Linda. My pleasure speaking here. So let me go into the slide sharing mode. Which you should see now. Could you just let me know if it's working?
Yes, it's working.
Wonderful. So the topic, as Linda said, is about epidemic risk insurance. As you all know, not an established niche segment of our market, but one which we hopefully see growing now. Certainly it has a lot of attention. Oh, hold on. I can't move the slides yet. Now it works. I'll structure the presentation on three main chapters. So first I talk about the risk itself a little bit before I then go to product design and underwriting. And lastly, I think worthwhile on this topic also spend a few words on market development and outlook, where things and developments might be leading. So maybe first a few words on epidemic risk solutions, our business unit as such, because it's an untypical business unit, which I guess we are still quite alone there in having such a unit. Worthwhile noting, we were started not after COVID-19, not as a response to COVID-19, but in the year 2017 already. So quite a while before. Really coming from the observation that there is quite an insurance gap, which, well, following the role as a reinsurance company, we would obviously like to kind of push the frontiers of insurability wherever possible and where useful. We were not quite alone in identifying that protection gap, as we've been working with many developmental banks and others, really trying to increase the resilience of economies and societies ultimately. Now, there's obviously one big reason why epidemic risk is hard to insure, and that's, as you all are very familiar with, the size of the risk. Because you can insure the epidemic outbreaks, but obviously then they can turn into a large global pandemic, and then you really have the accumulation risk, which is simply too big to bear all economic losses on the balance sheets of an insurance company. And you are familiar with these numbers, like the American Casualty and Property Insurance Association has done the calculations, like if all economic losses from this COVID-19 pandemic, business interruption losses would be insured, then obviously the capital base of the whole insurance industry would have been depleted within weeks. So that's not what we are talking about here to find a solution for the commodity markets. What we are talking here is about a niche market segment. For full economic losses, clearly you would need to have governments stepping in. But nevertheless, we believe it's very worthwhile to also establish and develop a niche market segment for a variety of reasons. One reason obviously being that there is room to work as the private sector, and every capacity which can be deployed by the private sector certainly also is a relief for the taxpayer. But then we also deeply believe it's important to have risk adequate solutions in the market and pricing signals to the market, because that's also very important for preparedness of the risk. So maybe with that general framing of the topic in the light of all the current political discussions. We have a unique mandate in that, as Linda said, it's a global mandate, but also it's really covering different lines of business. It covers life, non-life, public sector, and also capital market instruments. And the reason why we have this mandate is that we believe if you want to address this risk properly, it's so crucial to get the accumulation management right, and that you need to do in a centralized way. You can't just like open it for writing to everybody and then suddenly don't have the tail exposure where you want it to be. And you will be very familiar with similar discussions within your own companies. So we are based in different locations. Our main locations for the epidemic risk solutions team are Singapore, Munich, and London, with me myself sitting here in Singapore. Let's talk about the risk. So obviously epidemic risk is not a new risk in that sense that it's emerging after we all start using computers more than we have been doing in the past, such as cyber risk. But technically epidemic risk is a very old risk. It's with humanity since the beginning of mankind. However, the risk is changing in that sense. Well, first of all, we've all gotten very used to that this risk is not insured unless where it's automatically included in a life insurance policy. Of course, death by infectious disease is included. But because of that being already quite a peak risk, it's excluded from a typical business interruption product. And certainly the direction is, after the experience of the industry, and going in the direction to firming up on that one. Now, what we do see though, there is a trend of increasing risk. That's the environmental factors, that's increasing urbanization, that's increasing global mortality, in particular increasing the spread of diseases. And it's not a remote risk in that sense, if you like, because every other year you really have a large-scale epidemic outbreak. And on the right-hand side of the slide, you see a few of them. There's swine flu, Zika, Ebola, SARS, and MERS, which you remember all from the newspapers. There are a few like yellow fever in Angola, which don't make it so much to the international news, but which are there just as much. So if you like, you can look at it as a pyramid. So every year you have like 200 disease outbreak news issued by the World Health Organization. Many of them remain very small, maybe 1, 2 fatalities, 5 fatalities. Now, a few of them become bigger. A few of them become quite regional events. That's the ones you then really read about in the newspapers. And then there are the global pandemics when they truly cannot be contained in a region. The last one before 2020, COVID-19, the last one before that was the swine flu in 2009. Luckily, the mildest form of an influenza pandemic you could imagine. And the one thing which is important always for model calibration is, of course, the 1918 event, which was quite substantial event with 50 million fatalities roundabout globally at that point in time. It's important, oh, maybe, sorry, I go back, because one thing maybe still important if you compare to NatCat events. One thing in terms of analyzing trend to is quite similar. So there's the number of events and there's the number of economic losses, or the volume of economic losses. So same as on NatCat, you see a trend for increased losses or loss severity, but it's also partly related not only to increased events, but also due to the fact that, for example, you build hotels in areas where in the past you would only have had a mangrove forest. So of course, here the same thing, you see more events. The slide is of course exaggerating a bit from an illustrative point of view, but you also see a bigger economic impact of the events. So maybe that's important to keep in mind. If we look at how we've generally been viewing that risk, right? And you have that preconception that epidemic risk is often assumed to be unpredictable, unavoidable, uninsurable. And that we believe is not entirely true, because actually we think it is quite well modelable, like you can model it quite well. And again, because you have quite an actuarial database actually for the events. You of course have the topic of the large scale events, the tail of the distribution. How do you reach that? Naturally, your database is better for the smaller events, and where you need to go extrapolation, you potentially need to deploy other tools also, such as stochastic models, which you can use. But looking at these criteria of insurability, I mean, it is, if you look at the number of events, it is a random event. The individual events, I guess, are fairly independent. Naturally, once you are within the same event, which may last for many months as COVID-19 does, then of course the losses within the same event are clearly correlated. But COVID-19 versus Ebola in Africa, that's maybe rather uncorrelated and rather random. There is a few words to spend on uniqueness of events, but that I'll do on a later slide when we talk about policy structures. Keep that in mind, because that's also important to get pricing right. But of course, the size of the event is the one crucial factor. And not to be mistaken, we don't believe that Munich Re can hold the size of the losses on our own balance sheet. So our business model as insurance is clearly not based on that assumption, but really on the assumption that the large scale events are so big that they are too big for any balance sheet. So you need to ultimately put them on many, many shoulders to increase system stability, and many, in particular, non-insurance shoulders as well. So you need to deploy the deep pockets of capital markets. So to make epidemic risk insurable, you technically need to develop two markets. You need to develop the epidemic risk insurance market just as much as you need to develop the pandemic investment market. Only on that basis, we as an industry can really contribute in a meaningful way. I'll talk about that a bit later as well. Let's look at the products and the underwriting and pricing. So first of all, there's quite a bit of data available and publicly available. So I mentioned the disease outbreak news of the World Health Organizations and other multiple data sources. Not always consistent though, so there's a lot of data work to do. Now, of course, in building up our pricing base over the years, we have certainly cooperated with many others. There are specialized private companies who can also help for the data collection, for outbreak data, time monitoring, real-time or near real-time monitoring of events, risk analytics. We certainly have cooperated with academia. For example, if you build up a pricing base and then you see certain quantitative patterns, say that Ebola and Marburg look rather similar in the data pattern they leave, then it's good to talk to a professor of virology who confirms that indeed Ebola and Marburg virus are closely related, and that is to be expected. By now, of course, we have our own epidemiologist in the team, which helps a lot. And there is three stochastic risk models available by now on the market. That is AIR, Metabiota, and RMS with different strengths and weaknesses. This we do deploy to offer products for many different sectors. You see a list of focus sectors here right now on the non-life insurance side, but public sector, financial institutions, just as much. For building up a pricing model, there's quite a few things which you could consider. So obviously there are the epidemic outbreaks, pathogen specific or also non-named perils. So typically we do cover the unknown next virus outbreak just as much. You have to consider the economic loss in your pricing, because how does an outbreak of a certain size translate into an economic loss for a particular industry sector or particular company? Well, there's a massive variation even between individual companies within the same sector. And one other further element which we really have introduced as an additional element in our pricing is our accumulation risk management cost. So this we don't consider only as a loading in the normal risk capital, but this we really lift it up to have a separate element because it's so crucial for getting this niche segment right, for getting the pricing for epidemic risk right, because you can't ignore it. Otherwise, you're very, very limited in your capacity available. Now, let's start a little bit with the epidemic outbreaks as such, because as nowadays you're really familiar with from everyday newspaper reading, there are many elements you can consider. And a few very renowned ones are the case fatality rate and the R naught. The R naught is this initial reproductive number changing over time as the outbreak develops. Just to give you an illustration of early data work we have done, identifying good parameters for triggering an outbreak. So if you look at our not-in-case fatality rate, it's not as easy to choose, right? Of course, they determine in this kind of matrix the characteristics of a virus, but typically what we see in backtesting, the early estimates will always be imprecise, only as you have a sufficient number of data coming in. So simply a lot of sufficient number of people contracting the virus or even dying, only then these estimates become stable in the sense that once the event is over, then at that point in time, the trigger was sufficiently correct. And that there we're talking about, like, say, if you have 250 or 400 fatalities, then you are reaching the size of the outbreak where these kind of parameters do become stable. So maybe not the easiest for an early trigger. We'll talk about the triggers we are using more in detail later, but maybe just a few words on building up the database, a few of the experiences we have done, and talking about the epidemic part of the database, not so much yet about the economic losses. So obviously you have available data. You need to match that and benchmark that with qualitative criteria. And for such a complex risk like epidemic risk, that's really very important for a variety of reasons. Now, also you should spend a few words or thoughts about completeness and correctness, because you will find that, for example, near real-time data, as just mentioned, may deviate from the final view of the outbreak. You will see that reporting is not consistently across the size of the outbreaks. Many very small events are not consistently reported, which is important in fitting your distribution. And you obviously have different reporting standards in different countries. And it's not always as simple to say that the developed country has the better reporting standard. Not so in this case. For example, Africa has a fairly good data network for emerging outbreaks such as Ebola. So there you often find a surprisingly good data. Never a perfect data, nowhere. And of course, there may be, depending on how sophisticated you get in building up your pricing base, extensions, which you may want to consider. So you have a good actuarial database, but maybe you're still concerned, obviously, about the extrapolation into tail events, but also maybe you don't have a database and want to have a quicker start in pricing such risks. So then there are 3 risk models available. I named them before. And they are all working fairly similar. Just a quick intro or overview how these are typically built up, and you may be familiar with it. So typically you always start with the base matrix of events to generate. And in this case, all the 3 risk models work with the key virus parameters. So that is the combination of case fatality rate and transmissibility, R0. Then you vary where this outbreak with this virus characteristics is starting, in which part of the world are vaccines available, and so on. And you build up a large event catalog of like thousands, maybe 10,000 events, and then you do the stochastic simulation. So there, these are all quite similar in how they are designed. Now with this kind of tool set, now you can start looking at the products, and I give you a very brief overview of the different sectors. So here's one well-known example of the public sector, the so-called Pandemic Emergency Facility or Financing Facility of the World Bank. That is something where we were also mandated as a structuring agent and co-placement agent. The goal here was really to provide quick financing for containment of the outbreak, following the simple idea that if in a situation where so far you only have donor funding to react and to come, and that often takes time, wouldn't it be good to have an early on objective criteria when you should start containing the outbreak, much under the impression of the 2014 Ebola outbreak in Western Africa. And the idea is simple, as you all know, in an exponential growth, the earlier you can respond, the better the chance to contain it and to minimize the outbreak. And many of these concepts we also try to take over the learnings from these products into our private sector products, where we can also have elements of risk advice, risk management advice, and really enhancing preparedness and risk mitigation for the corporate clients in the end. Now, PEF, of course, did pay out over COVID-19. So there was a couple of $100 million dispersed when you had the sufficient numbers reached in the poorest countries of the world, because the mechanism was designed for the so-called IDA countries. And it shows that we as an insurance industry can really contribute here. And we believe that this is also in the future important, complementary to ex-post donor funding, of course, not as a replacement for it. But in many areas of developmental politics, you find that both concepts are liked in a combination. A few words on life insurance or life reinsurance. So that was a sector which in a way was easiest for us historically to build up in our portfolio, because here you have a regulated environment on the life insurance side. Pandemic risk is long recognized as a tail risk. You have many regulatory regimes requiring a certain amount of modeling and risk capital for it. So then a typical reinsurance structure would be an extreme mortality stop loss. For a primary insurance company, this could be done on an indemnity basis or on a parametric basis in general. If you do it on a parametric basis, say, for example, on the population statistics, population mortality statistics of a country, then you would typically, of course, form an index, weigh the different age buckets, age and gender buckets, so that they do match your portfolio demographics. And then you have your baseline index of mortality, maybe incorporating the trend of mortality improvement. And at a certain point in time, if the mortality level reaches an attachment point, a defined attachment point, the transaction attaches, starts paying out, when the full capacity is paid out, linearly increasing once you reach the detachment point. Maybe more interesting for you to spend more words on the non-life side, on the non-life products. So here we need to have a bit more complexity in the product definition than we need, for example, in fire insurance, because for fire, people usually quite well agree, well, this was a fire. Not quite so easy for epidemic outbreaks, because while we talk about epidemics and you all think about the Ebolas and SARS and MERS, which you have all known, now your client might think about, well, okay, I'm not an expert, it's all infectious diseases, isn't it? And suddenly you're talking to a hotel which also thinks about Legionella in the water system, which you could argue is more like a hygiene problem because the water temperature was not constantly kept above 60 degrees. Do you want to cover that? If you do, you need to have a different database and certainly a different premium level. Think about all the endemic diseases. It's not that all epidemic diseases start as a completely new event such as COVID-19 did, by jumping over from the animal population to the human population. Now you have malaria, yellow fever, endemic in many parts of the world. Sometimes the event becomes bigger and worse in a given year, and you would talk about an epidemic. So these things you need to obviously define carefully so that you can insure them. So call it an epidemic trigger or call it a product definition of insured event. That is necessary. And there are a few concepts. We typically in our products have three standard trigger concepts. One is the so-called severity scale. I'll talk about it in a second. One is relating to the declaration of a public health emergency of international concern by the World Health Organization. And the third one is the so-called FIKE combined with the civil authority lockdown. And that's obviously right now a scenario which very many clients have on their minds because we're in the middle of it. There are advantages and disadvantages. There are things to consider what to include in products. One element, for example, as an anecdote which matters a lot to our epidemiologists is be careful if you want to include all occupational diseases and suddenly create a moral hazard that companies might reduce production of their workforce. If you go to triggers being alerted like the FIKE, we might think about political risk, how stable or reliable this trigger is. That's solved. You would typically want to create an insurance product, hence you need to have a loss in gross profits, an increase in extra expenses, which then is insured and indemnified in some form of claims claim settlement process as any other business interruption. A few words on these trigger concepts. Severity scale or sliding scale is simply following the base logic. Well, the larger an outbreak becomes, the more economic loss it usually creates or causes, and often also the longer it takes. Hence, the more capacity you need to have available for as a sum insured. Now, you could argue you can, of course, provide the full amount of capacity at a certain point in time at the very beginning, but you all know that we do like risk layering as an industry so that we can do better pricing and also keep premiums more affordable to ensure we have that capacity available when we need it and not when we don't need it, but still need to price it in. So that is one concept which also ensures a smooth mechanism where you don't have this binary threshold at a high point in time. Another concept are the FIKes, which I mentioned. And just to give you a bit more information on these, because for good reasons, we don't use the WHO declaring a pandemic, which you sometimes see in discussions, but we really go for the FIKE. So this is the earlier one for COVID-19. It was announced by the WHO when we had 170 fatalities in China, and it was already clear this might become a larger scale event. Over the last couple of years, you had 7 of such FIKes announced, which you find listed here. So that we deem a much more suitable trigger. There are a few other elements to consider in product design. And due to the time constraints of the presentation, I'm just like kind of scratching on the surface a bit. But you might need to consider the outbreak area. Do you want to cover outbreaks which are starting in the whole world? Or do you actually want to cover outbreaks which are, for example, starting only on the Asian continent? And of course, you can offer both, but there will be a difference in the expected loss. Now, for example, we find, and similar to car insurance, right? Do you have only liability cover or do you have the full luxury package? Now, considering that most of the outbreaks, and like I'm talking about 90+%, starting in are causing an economic loss in Asia, same for Africa, did actually start in Asia, many clients might find that this is actually the scenario they want to insure and rather save a bit on the premium. So this is to be separated from the covered area. The covered area is naturally where do you want to insure the economic effect. That may be naturally in that region where you are located with your business operations. So if you're a US company, that would be the United States. But you might also want to add a second covered area in Asia if that is where your supply chain is, for example. So this covered area is typically tailor-made for the specific client. And naturally, then you know where are your insured premises within. Not enough on product structuring and getting pricing right. Here's an element for how a concrete product structure might look like. And that is something to be really think through as an actuary being asked to price that product. So you need obviously have a period of insurance, right? Typically 12 months, a year is your policy term until renewal of the policy. Now you have one issue with epidemic outbreaks that unlike an earthquake, they don't happen in a second, but they really happen over weeks and months. And say you have the COVID-19 is a very good example. Say you have a calendar year product term, right? 1st of January is your renewal date. Now, what did happen for COVID-19? The disease outbreak news, the first disease outbreak news of the World Health Organization relating to this outbreak was issued on the 30th of December. Covered under the 2020 policy or covered under the 2019 policy? This is a problem you should solve, because what you don't want to have is that you don't have uniqueness. You all are familiar with uniqueness of events being very important for pricing. You remember the 9/11 discussions. It was 2 towers and 2 airplanes. Was it 1 event or was it 2 events? So a similar problem here. Hence, you want to define one point in time, for example, the first disease outbreak news being issued, and then if that is within the policy term, the event is covered under that policy term. Now, obviously, then the event may only become severe much later. That is the so-called epidemic period. And there once the disease outbreak news has been issued, then we give 12 months of epidemic period for the event to unfold. And clearly that is a way of dealing with the extension mechanism, which is necessary to also create a fair product, right? Because you want to also ensure that if a client renews from year to year in a loyal way, that there is no coverage gap, or at some point in time suddenly say, well, hi, hold on a second, this outbreak already started. Now we'll certainly not renew for you. You want to have a fair product design. So then this epidemic period is one way of dealing with it, starting with the start of the event with the first DON being issued. Now your trigger, your event definition may be reached even later. And that maybe if the certain severity scale threshold is reached, or in this example, once you have the FIKE plus the civil authority lockdown being reached. And then from that point in time, you have obviously your indemnity period for a time period of 6 months, which we typically do. These are elements in product design, which we believe are worthwhile having there. We know there, and there are many things you can do wrong, you can ignore. Think of the early days of cyber insurance, when also many pricing and structuring mistakes were made. So there we hope we can support in kind of working together also with our clients to get these things in structuring right from the beginning. To develop the market, and that is really the purpose of it. Right now, it's of course a tiny niche market segment where you had quicker successes on the life reinsurance side and on the public sector side, the non-life insurance side. While we always believed that maybe the most important, the most scalable part of it, with the market development hurdle is highest. So the typical client to whom we have spoken before 2020, say in 2018 or 2019, would understand the risk. They need to understand their exposure, and there are other companies who can help analyzing that in a neutral way. Some kind of external risk analytics companies. But then it's of course an expensive product. If you are in Asia and if you are a hotel, which is very sensitive to the risk of an outbreak starting, because it's really consumers or tourists stay away even very early on due to the fear of the outbreak, then obviously that is something which you have to expect every, say, 20 years or whatsoever you come up with in your models. That's clearly a much higher risk exposure compared to your building down, your particular building and property burning down to the ground, right? Hence, you really have a expected loss, which is rather in the percent rather than in the per mil range. Over time, of course, you would hope to see more and more assets insured until hopefully at some point in time, the products can be readily available at a larger scale. Again, it's for developing what we can contribute as an insurance industry, including maybe other financial institutions or necessarily including other financial institutions. It's still, of course, not talking about all economic losses. For that, you would also need to involve governments, but that is a separate discussion. Important for this session in terms of pricing, maybe some words how you can deal with such an expensive premium or premium level or expected loss level. Obviously, you can talk about widespread geographical portfolios of certain clients or industry facilities. And ultimately, of course, your rate online is determined by the aggregate, right? So you can put that together in a facility and enable different primary insurers to participate, but also enable different assets to be insured. Now, the one question you of course have, how do you deal with this aggregation issue? So for, say, you have assets in different countries, for many more local events like the MERS 2015 in Korea, there's sufficient capacity. Now, if it turns into a global pandemic, a facility may not have the full capacity for all insured assets. That's why the premium per risk can be cheaper. Then of course you need to decide how do you deal with that implicit risk sharing, right? Does everybody get a proportional cap of the payout, or is it on a first come first serve basis? So certainly fairness comes into play. How do you want to design such a mechanism? It's one way of making products more affordable. Now, I implicitly mentioned how to involve capital markets in different ways, not the focus of this presentation today, but a very important focus of any business model related to epidemic risk. So a typical capital market investor, and I'm not talking about only ILS markets, that is too small a segment, but you would find that epidemic risk and pandemic risk still is a worthwhile asset class to invest in. Maybe just highlighting one part, obviously, so you need someone to transform. An investor wouldn't do the underwriting. So as a reinsurance company, we feel we are quite a natural entity and organization to do this risk transformation, which is necessary to make that accessible. But then you find that yes, pandemic investment does still increase diversification in a large scale investment portfolio, because of course a pandemic does trigger an economic reaction on the markets, but then a financial crisis like in 2008 does not start a pandemic. So there you have increased diversification, still not as good as with earthquake risk, but in a large portfolio, you want to mix in different ways. Now, maybe even more important from a relative value perspective, the return you see, the premium earned for pandemic risk, you see is higher than for a comparable credit risk exposure. So that's also in these times of low interest rates, not an unimportant fact. But as you all know, it's a big exercise to get this market development working and developed. Many parties, academia, insurance industry, politics are involved in this exercise. And with this, that was a short scale overview, and I'll close here. And I'm